Hi, I'm Jason with Cover6 Financial. In this session, we're going to simplify one of the most misunderstood parts of personal finance, life insurance. By the end, you'll understand the three main types: term, cash value, and final expense, and how each serves a different purpose depending on your goals. At its core, life insurance is about protection. Protecting the people you love from financial hardship if something happens to you. It can replace income, pay off debt, or make sure your family isn't burdened with final expenses. There's a lot of confusion out there, but almost every life policy falls into one of these categories. Let's start with the simplest, term life insurance. Term life insurance is straightforward. You choose a term, typically 10, 20, or 30 years, and if you pass away during that period, your family receives that death benefit. When that term ends, though, so does the coverage. You can usually renew it, but premiums increase because the older you are, the more expensive they become. Term life is ideal for families raising children, paying a mortgage, or replacing income during those working years. It's pure protection, nothing more, nothing less. The advantage is cost. You can buy a large amount of coverage for a very little cost. The downside, it eventually expires and builds no cash value over time. Here's an eye-opener. According to Investopedia, roughly 2% of term life insurance policies ever pay a death benefit because the insured outlives the term. That doesn't mean it's bad. It just means that most people live. Term insurance does its job. It protects you when your family needs it most. You've probably heard advice like, buy term and invest the difference. That can work if you actually invest that difference. But if you spend it instead, you could reach retirement with no coverage at all. So what happens when you want protection that lasts a lifetime, or coverage that can eventually sustain itself? Let's move into cash value life insurance. Cash value life insurance combines lifelong protection with a savings component that builds value over time. Part of each premium covers the insurance. The rest goes into a cash value account that grows tax deferred. You can access that value later through withdrawals or loans for emergencies, business opportunities, or even supplemental retirement income. There are three common types. Whole life has fixed premiums and guaranteed growth. Universal life adds flexibility in payments and death benefit. Indexed universal life, or IUL, ties growth to a market index like the S&P 500 without exposing your cash value to market losses. An IUL gives you a 0% floor, meaning your cash value can't decline due to market losses, and a cap that limits gains in strong years. It's a steady middle ground between safety and growth. Here's where younger people have a major advantage. Life insurance pricing is based on age and health. When you start a modest policy in your 20s or 30s, you lock in that low rate for life. Over time, your cash value can grow enough to cover the cost of the insurance itself. So later in life, the policy can keep itself going without new premiums. Now compare that to buying term insurance at 60. Premiums at that age can be sky high, and your health might make it tough to qualify. But someone who's had a well-funded cash value policy for 40 years may have a paid-up policy, no premiums, no expiration, and permanent coverage. Cash value growth is tax-deferred, and if structured properly, you can access it tax-free through policy loans. It's one of a few ways to build a flexible pool of tax-advantaged money outside of a 401k or IRA. So you're trading higher premiums now for lifetime protection, stable pricing, and financial flexibility later. It's not about quick gains, it's about a long-term leverage. Now, if you're already in your later years and just want simple, guaranteed coverage to handle final costs, there's a solution designed for that as well. It's final expense insurance. Final expense insurance, sometimes called burial insurance, is a small whole life policy, usually somewhere between $5,000 and $25,000 in coverage, meant to cover funeral expenses, medical bills, or a small legacy gift. It's designed for seniors who want guaranteed lifelong coverage without medical exams or complex features. Premiums never increase, coverage never decreases, and as long as you pay the premium, it lasts for the rest of your life. The pros? Simple approval, lifetime protection, predictable premiums. The negatives? Smaller death benefits and higher costs per dollar of coverage than term or larger permanent plans. But it brings peace of mind to many retirees and families. Here's a quick side-by-side view. Term, temporary affordable protection, cash value, permanent protection with long-term value, and final expense, small guaranteed coverage for end-of-life costs. If you're young and building a family, term usually makes sense. If you want lifetime coverage and potential cash value, permanent insurance can be really powerful. If you're in retirement and want to protect loved ones from the final costs, final expense coverage fits perfectly. According to LIMRA and the Insurance Information Institute, only about 51% of Americans have individual life insurance. That means almost half of households are completely uninsured. Ask yourself, how long do I need protection? What can I comfortably afford? And what do I want this policy to accomplish? Income protection, long-term planning, or final expenses? Life insurance isn't about dying. It's about protecting the life you've built. It's an act of love, not fear. And the more you understand your options, the more confident your decisions become. If you'd like to review your current coverage or just ask a couple of questions, visit cover6financial.com or email info@cover6financial.com. We are here to help you protect what matters most. And remember, we've got your six.